I think that the gold price in nominal terms, US dollar terms, will increase commensurate with the decrease in purchasing power. If you use $3,000 as a base, that suggests a number like 10 or 12,000 nominal US dollars 10 years out. Understand that $10,000 then won't buy you what $10,000 will buy you now. I suspect that gold will at least maintain its purchasing power. It may do substantially better than that. When the investing public adopted the gold narrative in the 1970s, gold did more than maintain its purchasing power. The price action in gold justified the narrative to the extent that investors and speculators, I would suggest, went way, way, way overweight gold. But we're not there yet, Cloudy. My suspicion is that if you inflation adjusted that $50 number, you'd come out with a number closer to 150.
Legendary investor RickRule points out that even if Washington revalued its official reserves from $42 an ounce to $5,000, it wouldn't solve the core problem. Creditors can't demand repayment in gold, so the mountain of U.S. debt would remain. A higher book value might buy time, but it wouldn't change the fundamentals. In his outlook, Rule expects the U.S. dollar to lose about 3/4 of its purchasing power over the next decade. If that happens, gold priced in dollars could easily trade in the $10,000 to $12,000 range. And even without that inflationary collapse, the numbers suggest significant upside. Precious metals currently account for only 0.5% of U.S. investment portfolios, compared to a historical average of around 2%. A simple reversion to the mean would mean quadrupled domestic demand and a doubling globally. That shift alone would be a massive driver for higher prices. For Rule, the bottom line hasn't changed. Gold remains a form of insurance. It preserves wealth when paper money fails, and gold mining stocks offer leveraged upside as the price of gold rises. RickRule points out that silver is where the real fireworks begin once a precious metals bull market matures. The cycle typically follows a consistent path. Gold moves first, then senior gold stocks take off, and finally, silver surges. What makes silver unique is its volatility and low unit cost, which gives it mass appeal once momentum builds. It doesn't take much excitement for retail investors to pile in, and when they do, the price action can be explosive. People often cite silver's old $50 peak, but Rule says that's a mistake. Adjusted for inflation, the real equivalent is closer to $150. Chasing a number misses the point. The real value lies in understanding why silver matters and being patient enough to wait for the cycle to unfold. That's how outsized gains are made. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I suspect, unfortunately, and I'll qualify the unfortunately, I suspect that gold will continue to do well. Gold does well when people are concerned about the maintenance of their purchasing power in fiat-denominated savings products. I think with regards to the world's reserve currency, which say the US dollar, that those fears are very well grounded. I don't fear for the dollar in a relative sense. In other words, I don't think it'll do poorly necessarily versus the pound or the euro or the Canadian dollar or the Australian dollar. But in an absolute sense, I suspect that the dollar repeats its performance in the decade of the 1970s, where over 10 years it lost 75% of its purchasing power. I wish I didn't believe that, but I do. And if you believe that, you need to look at gold's performance in that same decade, where it ran 30-fold. I'm not suggesting, by the way, Claudia, that gold is going to go 30-fold from here. It's already up 12-fold. But I believe over 10 years that gold will, more likely than not, the nominal price will mirror the decline in purchasing power of the US dollar. Consequence of that is that, yes, I'm bullish gold. I believe that the purchasing power of the US dollar will decline over the next 10 years by 75%. And I think that the gold price in nominal terms, US dollar terms, will increase commensurate with the decrease in purchasing power. If you use $3,000 as a base, that suggests a number like 10 or 12,000 nominal US dollars 10 years out. Understand that $10,000 then won't buy you what $10,000 will buy you now. I suspect that gold will at least maintain its purchasing power. It may do substantially better than that. When the investing public adopted the gold narrative in the 1970s, gold did more than maintain its purchasing power. the price action in gold justified the narrative to the extent that investors and speculators, I would suggest, went way, way, way overweight gold. Sorry to go on, but this is an interesting question to me. JP Morgan Chase, the big American bank, suggests that in the United States market, the market share of precious metals, all precious metals, including equities, is about 0.5% of total savings and investment assets in the United States. So it's a very small asset class. Probably more interesting, they suggest that the 40-year mean market share of precious metals is 2%, which would suggest that if we experience reversion to mean, demand for that asset class would grow fourfold in the US market. On a global basis, they suggest that the current market share of precious metals relative to other asset classes is about 1%, or double the percentage in the US. And they suggest that the 4-decade mean there has been about 2% because of limited Chinese participation prior to the year 2000. But again, it suggests on a global basis that a mere reversion to mean would double demand for gold on a global basis. Asian buying, at least Asian central bank buying, is a consequence of something that doesn't impact the U.S. as much. The U.S. has basically forced the Chinese central bank and other central banks to buy gold by weaponizing the U.S. dollar, in effect expropriating the SWIFT banking system, which was not U.S. property, by employing the threat of sanctions on the US dollar and US treasuries, and then, irrespective of how you feel about Russia, by stealing $300 billion worth of Russian holdings in US treasuries. If you run a government that occasionally, in a policy sense, runs afoul of U.S. preferences, you need to look at those actions and you need to say, I need to defend myself from that. So in the first instance, central bank buying around the world in gold is often an effort by those central banks to defend themselves from the U.S. The U.S. obviously doesn't need to feel the need to defend themselves from themselves. There's also been a change in China in the sense that Chinese people culturally have had a predisposition towards gold for a very long time, but private gold ownership was illegal. Now private gold ownership is encouraged. I would suspect that there was a deep well of support for gold in China that couldn't be satisfied when the Chinese government felt that gold was a threat to the renminbi. Now that private gold ownership is allowed, there is a deep, deep, deep cultural affinity for China. And remember, too, that China is a society that characteristically saves 40% of pre-tax income. So in addition to there being a proclivity for owning gold, there is also a means to acquire it. Two other attributes sadly lacking, despite the obvious arithmetic challenges that face the US dollar, and we can go into those later, there's still an awful lot of confidence in the US. The VIX, the volatility index, is dead. It looks like the electrocardiogram of a corpse. That doesn't suggest a lot of fear. There's a lot of liquidity in the system. There is still a lot of fondness in the US for risk-off assets, small tech stocks, crypto, stuff like that. That isn't an economy that would seem to be dominated by fear. But there are undertones. In the U.S., we are taught to believe that the correct measure of the deterioration of the purchasing power of U.S. dollars is a government index called the CPI, or Consumer Price Index. And I would suggest to you that that index is a joke. At best, a lie. I believe it for the following reasons. In the first instance, when it's inconvenient, the CPI doesn't include food or fuel. You can't see all of me, but if you could see that I like to eat. An index which doesn't include lunch is of no use to me. Secondly, it doesn't include tax. If I didn't have to pay the tax, maybe I wouldn't complain so much about the index. But commonsensically, if you're an American and you look at the basket of goods and services that are necessary for the maintenance of your family, which certainly include tax, food, or fuel, you will see that the rate of inflation in the United States is nothing like 2.5 or 2.6%. It's more like 7.5 or 8%. And that realization is dawning. The same way that that realization was dawning when I was a young man in 1968, 1969. It took a while for that conclusion to take hold. It probably took 5 years of being victimized by inflation before Americans noticed the gap between what their paychecks bought and what they used to buy. When that perception really took hold in the decade of the 70s, gold went from being an afterthought to being front and center in everyone's mind. Retail flows into gold, as measured by inflows into the gold-oriented ETFs and the trusts, really began between 20 and 22 weeks ago. So the increase that we saw in gold prices on a global basis didn't include U.S. retail participation until very, very recently. And I suspect, really, truly, unfortunately, that it's going to increase. A rational financial planner would look at me and say, say, Rick, you don't need to own gold. You have a gold stock portfolio and you're the largest shareholder in Sprott, which is a brand name for gold financial products worldwide. But I own it anyway because at 72, it's nice to sleep nights and stay calm. What gold has done traditionally over years has provided insurance. And I would still argue that the primary use for gold in most portfolios is to ensure the maintenance of your purchasing power through thick and thin, particularly thin. I'm also a gold stock investor, and that's different than gold. If you're a gold stock investor, you believe that the increase in the gold price will continue at a pace more rapid than the increase in the cost of producing gold. And as a consequence of that, producer margins will widen, free cash flow will increase, and hence the value of the business and later the share price will increase. We've seen in the last 18 months that the increase in the gold price has really fattened the margins of the best producers. And they've performed very handsomely. Not the gold equities market necessarily as a whole, but as an example, what I call the golden triumvirate, Wheaton Precious, Franco-Nevada, Agnico Eagle, the three highest quality gold mining companies in the world, have from a large base done spectacularly well. In prior bull markets, they run a very normal cycle. The market is led by gold, led by the fear buyer. The momentum in gold does two things. It legitimizes the precious metals narrative, but it also fattens the margins of the best, and they begin to move. When valuation disparities exist between the best of the best and the best of the rest, then the money begins to go down the quality trail. And we're seeing exactly that. This is a textbook gold bull market. Suggests that the best of the best are investment quality. Then, when you get down to single asset producers or developers or certainly explorers, you're in the speculative realm. I do all three. I own physical gold as portfolio insurance. In my declining years, I'm increasingly an investor as opposed to being a speculator. But I can't help myself. I love the speculative sector, and I think the money's headed there. No, what happened is that I bought a lot of gold some years ago, and the gold prices increased. And so gold has outperformed some other components of my portfolio. Particularly, it's outperformed my cash. I've maintained a very high liquidity in my portfolio since 2022. In 2022, I sold a developed real estate portfolio, thinking that interest rates were going to go up and I was uncompetitive as a real estate investor. And most of that money is still cash. What that means is that gold's weighting in my portfolio has gone up organically without my having to buy more gold, simply because the gold price went up.
RickRule argues that the inflation story the government tells doesn't match what people feel. The CPI, Washington's preferred gauge, excludes core expenses such as food, fuel, and taxes. On paper, inflation looks tame at 2 to 3%. In reality, Rule says it's closer to 7 to 8%. History shows how dangerous that gap can be. In the late 1960s, households didn't fully grasp how much inflation was cutting into their paychecks. By the 1970s, when the realization finally sank in, demand for gold exploded. He believes a similar awakening is taking place today, with U.S. ETF inflows hinting that retail investors are only beginning to move into gold. Then there's the debt backdrop. Officially, U.S. debt is $37 trillion. However, adding unfunded liabilities, such as Social Security, Medicare, and pensions, brings the real figure to north of $130 trillion. Stack that against the private net worth of Americans, about $141 trillion, and the math is sobering. The government owes almost everything its citizens are worth, and it adds roughly $4 trillion more every year. That isn't a reserve base, it's insolvency disguised by money printing. Let's get back to the interview.
Mercifully for you, Bullion Star customers can do their own reset. There's no reason why you can't have your own gold standard irrespective of government. Waiting for government to do it seems very far-fetched to me. Two comments on that. The first thing is that people who go into government and people who elect government, frankly, don't want fiscal discipline imposed on them. The purpose of government is to steal from one constituency and deliver to another. That's what it does. Gold eliminates the probability that governments can steal from the unborn. Gold is real money and it imposes discipline. No government wants to be disciplined. They want to discipline other people. The second comment I would make is even in the United States, where they revalue their gold, take all the gold that's alleged to be at Fort Knox and revalue it from $42 to some higher number, it doesn't do anything for the deficit at all. It doesn't do anything for the creditors either. Let's suppose that I buy some treasuries, some long-term treasuries. By the way, a highly unlikely event, but let's suppose just for fun that I did that. And let's suppose that as a consequence of $37 trillion in on-balance sheet liabilities, that the government experienced some difficulty paying me. Let's suppose now that I pull up to the White House and I say, hey, Mr. Trump, you owe me this money. I'd like my gold. Mr. Trump presides over a nuclear-armed debtor. The probability that I, as a creditor, could request payment in gold is nil, absolutely nil. So to the extent that they revalued it, they are revaluing collateral that a creditor could never seize. Even the central bankers aren't dumb enough to fall for that. What kind of reserve? In the United States, I can't speak to Great Britain, but in the United States, our on-balance sheet liabilities exceed $37 trillion, or $30 trillion net of the Fed's own balance sheet, 30 trillion net on balance sheet debt. But the off-balance sheet liabilities, according to the Congressional Budget Office, exceed $100 trillion. Now, interestingly, the Internal Revenue Service, similar to your inland revenue, estimates that the private net worth of Americans, assets minus liabilities, is $141 trillion. So let's look at the reserve math. Collectively, we're worth $141 trillion, and just at the federal level, we owe $130 trillion. That 130 trillion that we owe is growing by 2 trillion a year on balance sheet and another $2 trillion a year off balance sheet. So what reserve? We're $130 trillion upside down. The reserve, if it exists, means that they are printing specious currency units and using them to buy Bitcoin, if that exists. It's not a reserve. It isn't the creation of wealth. It's the creation of a distortion. As to the potential competition for investor interest between Bitcoin and gold, that's a very interesting question. It's worthy to note that the market share of either asset class is less than 1% of total savings and investment assets worldwide. So the relevance of each to the global financial situation is akin to the relevance of a pimple on an elephant's behind. They don't matter. They may matter to each other, but I suspect there's plenty of room for both. I suspect myself, people are attracted to Bitcoin because of its price escalation. People who look at its utility probably think of it more as an anonymous medium of exchange, which is very attractive, to be honest. Gold is also potentially an anonymous medium of exchange, but it's much, much, much less utilitarian. You can get Bitcoin across a border in a cell phone. Getting gold across a border is a bit more challenging. So I think that's a much more interesting question. I don't see a backed currency simply because the history of governments has been, unless they owe the money to somebody more powerful than themselves, they don't pay. Why would you, as a politician, subject yourself to discipline when you ran on the specific promise to be undisciplined? And why, too, would you constrain yourself to creditors when you have guns and they don't? Silver is probably the place, the asset class, that the speculative precious metals adherent should be participating in. I've been through 3 precious metals bull markets in my life, and they follow very predictable patterns. The gold, physical gold leads because the fear buyers first. When the momentum is established, leadership changes from gold to the senior gold stocks, and we've just seen that. At some point in time, the momentum in the precious metals price verifies the precious metals narrative to generalist investors, and the generalist investor comes into the market. When that happens, leadership changes from gold to silver. I'm not sure why it does. I suspect it's because of the lower unit cost, or perhaps the reputation for upside volatility. I don't know that it does, but I've observed that it does. And when that event happens, you won't need RickRule to tell you. We won't be talking about a move from $36 to $38. We'll be talking about a much more dramatic move. And I have a lot of confidence that will occur. I have no idea when. And the truth is, I've stopped caring when, because the moves are so dramatic that the rent your portfolio gets paid on its silver holdings justify the time that you spent waiting for it to occur. The very small population of viable silver companies does even better, because the consolidated market cap of that sort of silo of reasonable quality silver equities is so small that when the generalist investor tries to crowd into it, the market caps simply can't contain the money. In my first bull market in the 70s, watched Coeur d'Alene mines go from 10 cents to $65. I was too young, too dumb, too poor to participate. But the second precious metals bull market I was prepared for. We had 2 horses in that race, Silver Standard, which went from 72 cents to $45, and Pan American, which went from 50 cents to $45. They were extremely pleasant events for a young man. And I'm hoping to repeat that sort of fortune, maybe not with the same percentage gains, but I'm hoping to repeat that fortune, that sort of circumstance in this market. And I'm fairly confident that that will occur. Absolutely. And I've watched the last 3 markets, and none of them had anything to do with the industrial side. The truth is that gold does well when people are afraid. And that's usually, in terms of the broad economy, a counter indicator. It has been, in terms of its dramatic moves, always a monetary phenomenon. It's useful to the monetary case that the industrial case exists because some silver is destroyed in industrial processes. It's supply that goes to supply heaven. Damn near all the gold that's ever been mined, we do a weird thing. We take it out of a hole in the ground called a mine. We put it in a hole in the ground called a vault. But we actually use silver. Some silver goes to silver heaven. It gets destroyed as a germicide, or it gets used in a solar panel. It doesn't get recycled or something like that. And so you have circumstances where the industrial utilization of silver exceeds the amount of silver newly produced in the market, either via direct mine production or co-product production or recycling. We're in the midst of one of those periods today. But in my experience, not going back to the beginning of time, but going back 50 years, the real dramatic increases in the silver price are always monetary. When people talk about the former all-time high price in silver and they quote $50, that's a huge mistake because that's assuming constant dollars. You need to talk nominal dollars. My suspicion is that if you inflation adjusted that $50 number, you'd come out with a number closer to 150. I think people make a mistake with the headline prices that they assign silver. I don't like to do that anymore. I don't like to get people too excited. If you give people some number, they ignore the rest of the interview and focus on the number. And I think that's a mistake. I think people need to familiarize themselves with the entirety of the subject of gold and the entirety of the subject of silver. If you give them a number to cling on, they forget the why. And they can easily get shaken out of a good position that they should hold.
Some policymakers have floated the idea of a Bitcoin reserve, but RickRule dismisses it as financial theater. Bitcoin doesn't create wealth, it simply reshuffles capital. And while debates often frame Bitcoin as a rival to gold, he says both remain tiny slivers of global assets, each representing less than 1%. The real point isn't which wins, but how small both still are relative to the tidal wave of capital searching for safety. When currencies creak under the weight of debt and faith in official measures wears thin, will it be gold's steady discipline or silver's explosive momentum that investors ultimately trust to protect their wealth? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.